Hello. Today we're going to do a little market update. The markets have been quite volatile the last really few weeks, but more or less the last few days have been seeing some big downs, some big ups. So just wanted to do a quick update on what's going on. Of course, the big news is out of China. The largest developer in China is having financial troubles. And so this is causing a ripple effect throughout the world markets. And just so you have an idea of what happened, this developer in China, their mode of business was to sell people houses sometimes years before the house would actually be built. And so people would agree to purchase the house, they put the houses under contract, and then a year or 2 years later the house would be finished and delivered. And this was a great way to make money in China because people would put houses under contract, and by the time they actually got the house, it would be worth a lot more than they paid for it. And so this ended up being a source of investment return for a lot of people in China. So the prices of these houses begin to get bid up and bid up and bid up because anticipation that the price would be higher in the future. And what's happened is now this company, Evergrande, turns out they're taking in all these people's money, and they don't have enough money to actually deliver the properties that they promised. So about $300 billion in debt. Looks like it could be under default. Looks like the Chinese government, which is a real big part of the economy and businesses in China, looks like they may bail out a lot of Chinese investors, but they're going to let the foreigners lose their money in the investments, which obviously is going to be very negative for future foreign investment in China. But at this point, the whole thing looks like it's pretty manageable, assuming it's just this company. One of the big concerns is that this is representative of other companies in China that are doing similar types of things. And if you have one company that is cutting corners and not doing the right thing and doing fraud, maybe there's other companies. And so, of course, this could spread throughout the economy. And, of course, that is the concern. So this has caused a lot of volatility in the markets, and we're watching this and seeing what's going on in the market. Ultimately, I believe, even though this is a deflationary incident, I believe that it will ultimately be inflationary. And the reason is I believe that there will be government involvement, maybe not just in Evergrande, but in other areas, to create stimulus, to basically paper over all of the problems. And so, of course, this will cause additional inflation in the economy in the future. And so I'm not as concerned about Evergrande in China as I am about what it looks like here in the US as far as inflation. And this is the area that we have definitely bet correctly that inflation is going to be a lot worse than we were told. And of course, all the agriculture, all the energy, a lot of the value stocks, they were doing very well, and our accounts are up and everything's doing great. The one area that has been a lagger is the precious metals market. And you would think with inflation as high as it is, I mean, the official number is 6% now, according to the recent GDP report. If it's 6% inflation, boy, this is 300% higher than the government's target of 2%, the Federal Reserve's target of 2%. Boy, this is a lot of inflation. So maybe gold should be going up. Well, there's some reasons why gold is not going up. And the reasons are, number one, the talk on the markets and Federal Reserve is that it's temporary or transitory. And they're blaming it on supply chain and COVID and getting people back to work. And supposedly it's not a monetary phenomenon, it's this supply chain, and this is what's causing the inflation. And of course, it's going to come back down and everything's going to be fine. I think that it's really not accurate. I believe that inflation is here to stay, and I think it's a lot worse than they're making out. In fact, I think the 6% number is really a fake number. At the end of the day, they're using all kinds of adjustments on the GDP number for inflation to come up with the 6%. For example, rents are an example. Actual rents are up over 12% year over year, according to actual rent numbers. And home prices are up 19% year over year, according to the average home price in the United States. Yet owner equivalent rent, which is the accounting adjustment that the government does to housing, is only up about 3%. So when you start looking at those numbers, you realize that real inflation is probably substantially higher than 6%, maybe as high as 10%. And we're seeing that in a lot of the reports from the corporations. For example, FedEx just reported, and they're increasing their prices by 6% across the board, and that's in line with the 6%. Yet their stock price is still down. It's down about $90 a share from where it was not too long ago. And the reason is people are worried that they can't pass along the costs fast enough. So their labor costs, their costs for fuel, all of that is going up so quickly that they cannot keep up. So when you start looking at those numbers, I do think inflation is going to be a lot worse than they're making out. I do not believe it's going to be temporary or transitory. So that's the first reason that precious metals hasn't moved. The second reason is, even if it's not temporary or transitory, the Federal Reserve has assured us that they're going to use all of their tools that they have in order to force inflation back down, and they claim to have all these tools that they can use. And of course the big one is to do quantitative tightening instead of quantitative easing, and to reduce the amount of purchasing they're doing. But it's kind of funny, they're producing $100 billion a month in purchases in the fixed income market, driving interest rates down on mortgage-backed securities and corporate bonds. And ultimately they say, oh, the economy is good, employment is good, everything's great, but we're going to keep printing all this money and buying all these fixed income securities. So I think that it's really for show. I think that they are signaling that they're going to do the right thing, they're going to use the tools, they're going to do this, they're going to do that, but ultimately they're not going to do it. They're going to let inflation run a lot hotter than what they're making out. And of course, at some point when the market figures this out, we're going to see an even larger increase in the energy and agriculture and things that we've seen already, and precious metals will soon follow suit, and we'll see a big increase in that area as well. So that's what we're counting on, and so we're going to keep a lot of the positions on. Of course, there could be a major deflationary event where the markets really break down and they really fall down. I think this will probably be followed by a lot of stimulus to drive the markets back up. So I'm not concerned. I think the only thing temporary would be a big drop in the markets. But if that happened, we do want to have some protections in place to protect ourselves. And we've done that. We have a lot of money on the sidelines at this point. We're a little nervous about current valuations, market cap to GDP, so on and so forth. So if we have a pullback in the markets, we can get more aggressive and we won't take as big of a hit. And of course, the buffered index, which we're using quite a bit for most of our clients, has been doing very, very well. You're getting good returns. You got the insurance on there. A lot of those are coming due now with 10% plus returns. And then we're just putting it right back into another one, creating some more insurance. And so the most recent one we have available coming up October 15th is a 12% cap on the Dow with a 10% insurance protection. So a pretty good one. The S&P we recently had was a 10 up, 10 down for a 1 year basis. The Dow's a little bit smaller group of stocks, only 30 stocks versus the 500 in the S&P, but looks to be a pretty good one. So this is what we're doing. We're doing our best to protect the accounts from what we see as a lot of volatility in the market, but we still have our eye on what's going to happen in the future. And I think this inflation is here to stay, and I think it could get a lot worse. And so we're investing to protect your accounts from that inevitable outcome. So hope that was a good update for you on the markets and what's going on. And feel free to reach out to our office if you have any questions. And we'll keep watching those accounts and make adjustments as necessary.